Transferring wealth successfully starts with asking yourself questions that will give your family a better life now and for generations to come. In this podcast, financial professionals John and Michael from Copper Beech Financial Group guide you through eye-opening questions to help you discover the truth about your wealth. Now, on to the show.
Hello and welcome to The Truth About Wealth with John and Michael Parise of Copper Beech Financial Group. Today, they have a special guest in studio, and that is Brandon Hughes from Peachtree Hotel Group. Good afternoon, gentlemen. How are you?
Good afternoon, Eric.
Good afternoon.
Good afternoon. Doing well.
Welcome, Brandon. Thank you so much for being on the show. I'm excited to hear what you have to say. Michael, why'd you bring Brandon on today?
Well, Brandon is, and if you've listened to our podcast in the past, we outsource to specialists when our clients have particular needs. And one reason why we had Brandon come on the show today is Brandon's going to talk about qualified opportunity zone funds. And this is, I'll let him explain sort of the history of the legislation. But this is an area of the most recent tax law changes at the end of 2017 that's really now starting to pick up. And a lot of our clients have expressed interest in sort of wanting to understand what they are, how they operate, why they're in place. And so that's really why we brought Brandon on here today.
So with that said, Brandon, why don't you just talk a little bit about the code itself, what changed in the tax law to benefit this particular strategy, and then talk a little bit about how you guys operate in that particular program.
Yeah, sure. And John and Michael, thanks for bringing me on the show today. And just a little bit about me and my background. I am responsible for developing and executing capital strategy for the firm and serve as a contact for the investor community. And so I've been in private equity funds, also have been in the institutional fixed income world on the bond side. And so I have a pretty deep background on structuring private equity type funds. And so later in the show, I'll get into a little bit more about what Peachtree does. But there was a bill or a law that came about pre-2017. So going back to that time frame, there was a gentleman by the name of Sean Parker. And a lot of folks remember Sean as the Napster guy. And if you remember downloading some of the free music back then, that was him. Didn't make a lot of money.
I remember that from my youth. Yes.
Exactly. And so he didn't make a lot of money doing that because you can't make a lot of money downloading illegal music. But he was the first CEO of Facebook and made a lot of money at that. And so I think he was there for a pretty short tenure and was off probably sailing the world and came up with an idea that if we incentivize the investment community with the investors that have capital gains to invest those capital gains into quote unquote, these lower income areas across the United States, we think we could boost these economies in these distressed areas. And so he enlisted Tim Scott, who is the Republican senator from South Carolina, and Cory Booker, a lot of you guys know up in New Jersey, the senator there on the Democratic side, to draft this bill. And so it had bipartisanship support going back to 2015, 2016, and ultimately was wrapped up into the 2017, the Trump Tax and Jobs Act of 2017. And so it quickly passed, and a lot of developers across the country were kind of off to the races to find certain areas that they could develop real estate in, and or find a piece of property that they think they could redevelop. And part of that law, there's really two ways that you can benefit in these opportunity zones. One is to build a brand new asset in these opportunity zone areas, or find a piece of property with a piece of real estate on it and double the basis in that property. And so the easiest, and again, I'll get more into what we do, but the easiest for our purposes at Peachtree Hotel Group was to develop new assets. And so there's really three main benefits to the law for the investment community. One is you have to have a capital gain. So it can be long-term or short-term capital gain. It can be derived from any source. So it could be derived from equities, so a stock position. It could be from real estate. and there's certain intricacies of the law, and we can get into those. It can be from a business transaction. So if you sell a business, it could really be from any capital gain. And so when you invest that capital gain into these quote unquote lower income distressed areas and these qualified opportunity zones, you get to defer your taxes today. And so you're not paying Uncle Sam today. And you fast forward that 7 years out to the year 2026. So if we're in 2019 today, you're maximizing the full benefit of the law. You defer the taxes in 2026. The law states that you will have to pay long-term capital gains or short-term capital gain rates in 2026. So whatever you go in to a fund in 2019, that's the rate you'll pay in 2026. Now, one caveat there is we know what long-term capital gain rates are today. We know what short-term capital gain rates are today. We do not know what they are in 2026. So you have to be comfortable as an investor knowing that they're going to reset in the year 2024.
Yeah, that's a good point.
Right. I mean, and that's an important caveat because, to your point, you're not deferring the gain as you would owe it today. It's whatever the gain is at that time, correct?
That's correct.
Right.
And that's the first benefit. Second benefit, the IRS is being very nice and saying, we're going to give you a reduction in your tax bill in 2026 in the form of a step up in basis. And so going back to investing that capital gain, when you invest it day one, you have a zero basis. And so having a zero basis, they're giving you, after a 5-year period of being invested in these funds, a 10% step up in basis. If you hold it for a 7-year period, which takes you to that 2026 date, you get a 15% step up in basis. So I like to think of that as a reduction in your tax bill. So I'll give a quick example. If you invest $1 million today in 2019, you defer those taxes. In 2026, you owe long-term capital gain rates on $850,000 based on the rate in 2026.
Yeah, that's a. I mean, really, I've not heard of a benefit like that. In that's a pretty unique tax benefit to this particular legislation. And just to add to that, Brandon, one of the reasons why we wanted to have you on really as soon as possible is because, correct me if I'm wrong, you really have somewhat of a window in terms of really investing into these qualified opportunity zone funds before the end of 2019, correct, in order to get that full benefit of those taxed or that step up in basis, rather. Is that correct?
That is right. So thinking of going into 2020, the funds will still be around, but your benefits now change to you only qualify for that 10% step up in basis, and you're 1 year closer to paying your taxes in 2026.
And that's a big piece.
It is.
Yeah, so that's one of the reasons why we wanted to have you on is to get, obviously to get the word out, where if that's something that interests a listener, they sort of, time is of the essence a little bit in terms of investing into these. Now, as we'll probably talk about and expand on in a little bit later, we never want to necessarily let the tax tail wag the dog. So there obviously has to be a really compelling reason to do or make this investment anyway. But it is an important thing to note if you're considering this.
Brandon, these zones are always intrigued me because when you look at how that kind of rolled out, you're reading articles that Scottsdale, Arizona has opportunity zones, Manhattan has opportunity zones. They're not necessarily lower end areas for development. But who's making the election on these zones under this program?
That's right. That's a very good point. So when they were designing these so-called opportunity zone tracks, the only data set they had to go off of was the last census, which took place in 2010. So if we all rewind back to 2008, 2009, 2010, coming out of the worst financial crisis we've seen, a lot of areas across the United States were quote unquote distressed at that time. And so when they did that census in 2010, that's the data they had to use. And so when you look at a Phoenix, Arizona, which we have a project going on in Phoenix, that was probably the hardest hit city in the United States based on the residential mortgage crisis. So we get to, as a developer, build an asset in downtown Phoenix based on that 2010 data. And so there's 8,700 tracts across the United States. Some of them are rural, which makes sense for an opportunity zone. You're probably not going to find too many developers developing something in a cornfield in Indiana, but it probably qualifies as an opportunity zone.
Right.
But then, to your example, there's places in Manhattan, on the west side of Manhattan, just 3 blocks from Columbus Circle, that qualify for an opportunity zone. 90% of Scottsdale qualifies as an opportunity zone. There's places on the Vegas Strip that qualified as an opportunity zone. And so the governors and their offices of each state were able to identify 25% of their state as these lower income distressed areas. Now, those are divided up all across the state, and there's a lot of instances where there's an opportunity zone, and just across the tracks is a non-opportunity zone. And to give you an example, we have a project in downtown St. Louis, Missouri, which sits next to Union Station, which is an old train station that they've redeveloped, which is kind of a happening area in St. Louis. We're building a hotel right next to that, which happens to be in a qualified opportunity zone. And so you're finding a lot of those across the country in desirable areas and downtown type markets where you've seen kind of this regentrification where folks are moving back into the city versus what it looked like in 2010.
Yeah, the only reason I brought that up, really, because everyone looks at real estate differently, but you and I both know it could be a risky asset class depending on it's always location. So my concern for my clients when they ask me questions about this, a lot of these opportunity zones are in good real estate plays. They're in good areas because of this new law that happened to be with the census issue. Have an opportunity to invest in some really good real estate, good areas in these particular zones themselves. So it's fascinating to me how that all unraveled.
And that's also another good point to where when we're moving into 2020, that's the next census that will take place. Now, that'll take a few years to finalize, but if you're looking at qualified opportunity zone funds today, in our opinion, as a developer, we think it's the best opportunity and the best timing to be developing real estate based on that stale data in areas that we can build that were distressed back in 2010, which will change moving forward. But funds that are out today are grandfathered in for that 2010 data.
Yeah, that's really interesting. Is that when we've talked about, or when clients have brought qualified opportunity zones up to us, and one of the things that they're concerned about is, well, where are these projects being invested in? I understand the purpose of sort of revitalizing lower income areas or distressed areas, but that maybe isn't necessarily the best area that I personally would want to invest into. And I think your outline of some of these areas of the United States and projects areas where it's distressed, but the level of distress is maybe not what a lot of people think of.
That's correct. When you hear of distressed or lower income, you automatically think of the bad or poorer areas of town. I live here in Atlanta, Georgia, and you'll find that a lot of the opportunity zone in Atlanta is on our west side, which happens to be a natural lower income poorer area for our city. And of course, as a developer of real estate, that's not an area that we would go and develop a hotel. But there are a lot of areas that qualify as opportunity zones in Atlanta that make sense. So it has to make sense from a real estate standpoint, going back to don't let the tax incentives wag the dog. So you have to look at the type of real estate that you're investing in, the areas these projects are being built in or being redeveloped, and then feel comfortable with that investment, because really ultimately the third benefit out of the three is the best benefit, and that is to grow money tax-free and it to be distributed tax-free. But for that to happen, you have to be in these qualified opportunity zones funds for a 10-year period, 10-plus year period. And so you have to feel real comfortable with the real estate, the funds that you're going into, because it's a long-term relationship in these projects.
Yeah, that's a great point. We did sort of dovetail away from the tax benefits that you were talking about initially, but I agree. I think that last one is really where there could be a lot of potential benefit for investors, assuming you pick the right investment. To your point, because you do get that let's say that tax-free nature of your investment into the fund itself if you hold it on for 10 years. But that brings up another question that hopefully you can help me answer with, is sort of when you're looking at, or when you're working with clients, what sort of assets are they, or gains, I should say, are they looking to invest into these funds? Because if you do have, let's say, that 10-year hold, I imagine that there are certain types of assets that families may want to consider or may not want to consider depending on their personal needs. Do you have any thoughts on that?
Yeah, sure. So, going back to who is eligible to invest their gains into these opportunity zone funds, it can be an individual, it can be a corporation, it can be an S corporation, it can be a trust. And so, as long as there's a capital gain scenario, it can be invested into these qualified opportunity zone funds. What's not allowed, or at least we're not allowing it in our programs, are to invest anything outside of capital gains like cash. We get that question a lot. And ultimately, you can invest cash, but the IRS is not going to give you those tax benefits. So ultimately, you're investing in just a long-term development fund that you're not getting tax benefits on. So there's probably different avenues that you can probably access and other development deals that are more tax efficient. So we get that question a lot. And then on the capital gain side, it can be short-term capital gains, long-term capital gains, Section 1250 and 1231 gains, which pertain to real estate and security sales. So we've gotten a lot of positions in our fund due to where the stock market is today, over concentration in stock positions where they're rebalancing, and so they're rolling over their capital gain portion into our fund amongst other funds for diversification. We've seen quite a few business sales, so it has been a tipping point for generational businesses that maybe want to sell or have thought about selling, but now is the opportune time to do that because they don't have to pay taxes today, and this is an avenue to grow money tax-free over a period of time. And what we've seen and what we've heard, there's just not a lot of avenues to do that, and so the tax law has created that.
Yeah, we do a lot of trust work, and that's why I'm always excited to look at ways to be more tax efficient in trust because they're heavily taxed. So this is a very, very good position for real estate because most of our clients own real estate as a big asset class to their net worth. So they're always looking for ways to move that generationally. And this could be a very unique process to have a trust own that real estate, wait the 10 years because it's a long-term strategy and get away with the capital gain benefit. I think it's exciting for that particular position.
That's right, and everything we are hearing are that these programs are working. They are creating growth in these local economies and creating jobs, and I think that'll happen for a long period of time as the real estate is built. There'll be more permanent jobs versus the construction side of the aspect right now that are creating jobs.
I'm watching things develop, and I'm a little concerned. And again, it's just my point of view. A little concerned, and you brought it up earlier. Parts of the poorer areas of these zones are not going to be developed because there's more of a risk for the real estate play, so they're not going to be developed. So that's kind of backwards, I think, from where they're trying to work with this tax benefit. What are your thoughts on that?
We somewhat agree to that, and ultimately, it's one of those things that if we decided as a developer to go put a hotel in that area, we're not going to have much demand coming to stay in our hotel, maybe because there's a lot of crime in the area or whatever reason it may be. But what we are seeing is that when you look at these opportunity zone tracks, especially in these primary, secondary cities like our St. Louis project, we are in an opportunity zone, but right across there's a non-opportunity zone. So we're getting folks from these lower income areas that are getting jobs for these projects. So if you ask me what is probably one of your biggest concerns today on the development side, it's the labor pool. So there's just not enough folks out there in the labor pool. And so we're able to hire some other folks that maybe you wouldn't before as day laborers. But ultimately, it's putting paychecks back into the economy, or a paycheck to their family. And if the project wasn't happening, that wouldn't happen.
That's interesting.
Yeah, personally, that was my hope that would be developed, because it's all about jobs. You listen to the president, you listen to the focus on this. It is about jobs, and the real estate benefit, or the capital gain benefit. It should be a secondary issue, but it's not. But I hope they both come together and develop synergies and make it all work.
Well, and if you look at us as hotel developers, which we'll get into in a minute, most of the workers in our hotels are the maids that clean the rooms, the folks that work the front desk, which are typically hourly workers, which are inevitably are pulled from that lower income area, and so that's ultimately good that they're able to find a job closer to where they live. And so I think these programs are working from that aspect as well.
Yeah, it sounds there's a lot of spillover benefits that maybe, or maybe they did think about it, but that one wouldn't think of right off the bat. This is interesting.
I talk about your firm at this point, if you wouldn't mind, Brandon, so that the audience gets an understanding how you kind of operate in these zones.
Sure. So Peachtree Hotel Group, again, is the name. We're located here in Atlanta, Georgia. Really started as a product of the financial crisis. So 3 gentlemen started the firm really as a family office to manage their own capital and friends and family capital. 2 of them grew up in hotels, literally from day one, cleaning, working the front desk, cutting keys back when they did that. And the other partner, who was our CEO, grew up on the lending side of the business, so the finance side. And so they quickly took advantage of the financial fallout and were buying deeply discounted hotels and notes. And so that hasn't changed today. We still operate the same way with the same thought process. It's just kind of is grown over the years. But we have been developing brand new hotels since day one, since 2008, 2009. And we stick to our investment thesis, which are sticking to premium branded hotels. So for the purposes of our Opportunity Zone Fund, they're all Marriott or all Hilton properties. So they just have very strong reservation systems. We're tapping into the business traveler, if you will, that is gaining points, and that's what you get when you partner with a Marriott and a Hilton. To go a little further, we operate, manage, and develop select limited service hotels, which are you're probably familiar with the Hampton Inn by Hilton or Courtyard by Marriott.
Those are all of them.
Yeah, exactly. Those are 80 to 150 room hotels, and we like that segment of the hospitality sector because you can manage those hotels in good times, and we can manage them in market downturns or recessionary type periods, as long as we're in the right locations. It doesn't take a lot to run those select limited service hotels. There's operational levers that we can pull when we are in that down market. But to drive it a little further, we do deals in secondary, tertiary cities where there's natural demand drivers that are around university markets with medical research, hospitals, airports, for the purposes of opportunity zones in downtown markets. And so how we backed into these opportunity zone programs was when this bill was being talked about that I mentioned earlier, we took a look at our pipeline of new development deals that we went to Marriott, we went to Hilton and got a brand approval in a certain market across the country. And we had 22 of these individual asset deals we wanted to do. And 11 of those, when we put that opportunity zone track map on top of ours, 11 of those 22 fell into opportunity zones. So when you look at select and limited service hotels and the locations they are in, they naturally fall in those airport markets, which tend to be lower income.
Yeah.
University markets, which tend to be lower income because of the student body. And then the point I made earlier, the downtown markets were very distressed back in 2010, and they look drastically different today. So there's a lot of demand, natural demand in these areas, and these were deals that we underwrote before that made sense. The economics worked. Our investor return hurdles made sense. And so we just put a fund wrapper around these 8 to 10 projects that we're executing on. And so we have a fund now that we have 4 projects in the fund already. 2 of the hotels are almost completed. So again, it is working. There's job creation in these markets. And then moving forward, there will be even more job creation, more permanent creation once we open these hotels.
Yeah, that's it. I mean, that's what really, again, getting back to that conversation of not letting the tax benefits wag the dog. I think that's really key because, like you said, you sort of already had this investment or these investments at these hotels in your pipeline, and it just so happens that the legislation overlapped very nicely.
Favored you, sure.
Which I think is something to always look at, because another question that I'm sure you can comment on that our clients have sort of talked to us about is sort of, okay, who are the companies that are putting these together? Because now that this legislation is in place, I'm sure whether you have competitors or whether they're larger or smaller, but there's a lot of companies or individuals that are trying to get into this market. And I think that can create a situation where investors have to be a little bit wary. So do you have any thoughts on that?
Yeah, I mean, and that's a good point. And that's a concern for a lot of funds out there, that maybe they're overpaying for the land where they're developing. And then, the labor market's also another point we talked about earlier. But for us, these were deals that we had in the works prior to this reform. And so we're just acting on those and closing those. And so we're partnering in a lot of our deals with local people that were in these markets that own land, that they are a JV partner with us on that individual asset. And so as the law, is stated, if you own land pre-2018, you actually can't take advantage of these qualified opportunity zone programs, that you have to sell your interest to a qualified opportunity zone fund and can't own more than 20% of that individual asset. So it worked out very well for us, and that's how we were able to get started right away. In our industry, it's shovels in the ground, and that's why 2 of our projects are almost completed, and we'll be able to open those hotels up. But there are a lot of concerns, and we're hearing that out there, that there are funds raising capital. They're just having a hard time closing on deals and finding deals that make sense for the investor, and that can always create some issues. And so we're fortunate that we launched our fund in December of 2018, and we've raised roughly $100 million in capital and have been able to close on the 4 properties. We have 2 more under contract. And so, again, getting back to, we're just executing our strategy that we were going to do regardless.
Yeah, that's great. That's great. What's your thoughts about, because we always get pushback from clients, there's a recession coming. There's going to be a downturn in all these sectors, real estate, stocks and bonds. From a recession standpoint, how do you think you fit in a down market on these projects? I know you mentioned a few minutes ago that you're positioned pretty well, but that would be a concern of some of our clients. What's the risk? Although obviously it's 10 years, but remember, 80s were a very tough real estate decade. So a lot of people have that memory that we work with. So how do you answer that question to these clients?
Yeah, definitely. And, we hear that daily. And I think we've been waiting on this recession for 5 or 6 years now. Yeah. But we do know it's going to happen. It's inevitable, right? So it's a natural business cycle. We don't know, what that looks like and how severe. If it looks like an 08.
No, it does. Yeah.
Or if it looks like the one that I don't think anybody remembered back in 2011, 12, that looked like one. But yeah, we have that factored in. And so from an underwriting standpoint, we are very, very conservative. We actually underwrite all of our deals to those 2008 scenarios. Are we comfortable building this property, owning this property, managing it, if it looks like 2008? And that's ultimately what it comes back to, the location, the type of asset that we're building, being a select limited service, partnering with a Marriott and a Hilton, where everyone in the world knows the brand. It's like Coca-Cola, Home Depot. And so we can minimize a lot of those downside risks, but we also know that we're managing to a 10 to 12 year period. So we may even see two, market downturns in that time period, and we're very comfortable with the locations, the assets that we own. Another point to make: there has been some regulations that the Treasury Department have put out, and for these opportunity zone programs, and one of them was that we can sell assets along the way, and that was unclear out of the gate. And so we are able to build an asset, sell the asset. So if it makes sense for the investors, if we can double or triple the equity in a 3-year period, that makes sense for investors as long as we have another project that we can roll into. So we have to invest that capital into another project within 12 months of that transaction. So we can minimize some of that risk as well if we see opportunity along the way, which is drastically different than when it was unclear if we weren't able to sell assets and we had to hold on to those assets for 10 to 12 years. Although with our program, we're very comfortable and we underwrite to a 10 to 12 year period. But that just kind of gives us more flexibility on that side.
That's great. Well, Brandon, unfortunately, I think we're running out of time today. This has been a really great conversation. And, thank you so much for educating us and educating our listeners on this unique investment opportunity and tax opportunity that again, somewhat as time is of the essence if you want to maximize all those benefits. End of 2019, correct, is sort of the deadline, which you have to invest. As I understand it, right?
Yep, for to maximize your benefits. And just I know we're out of time, but recap: just getting the deferral up front, you get that step up in basis. You get the full 15 if you're invested in 2019. It changes to a 10% in 2020. But certainly, if you're thinking about doing it and are going to do it, I think 2019 makes sense.
Great,
excellent. Thanks, Brandon.
Well, thank you guys. And if you have any other questions, please forward those to me. I'd be happy to help.
Thank you so much.
All right, that was my next question. Actually, guys, this was a great podcast. For those that are listening that do have questions, can you just go ahead and give your phone number, Michael and John, and just let them reach out to you, and then you can figure out how to put them in contact?
Sure. Our phone number is area code 856-988-8300. And you could, if you're interested in whether it's Brandon's program, you can call our office and we can help you out with that.
Fantastic. And thank you all for listening to the Truth About Wealth podcast with John and Michael Parise. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when John and Michael come out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your friends and family. Again, thanks for listening today. For everyone at Copper Beech Financial Group, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Truth About Wealth podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Copper Beech Financial Group. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.
This material is for informational purposes only. Neither APFS nor its representatives provide tax, legal, or accounting advice. Please consult your own tax, legal, or accounting professional before making any decisions. Securities offered through American Portfolio Financial Services Incorporated, a member of FINRA SIPC. Investment advisory and financial planning services offered through American Portfolio Advisors Incorporated, an SEC-registered investment advisor. Copper Beech is an unaffiliated entity of APFS and APA. Any opinions expressed in this forum are not the opinion or view of American Portfolios Financial Services Incorporated, APFS, or American Portfolios Advisors Incorporated, APA, and have not been reviewed by the firm for completeness or accuracy. These opinions are subject to change at any time without notice. Any comments or postings are provided for informational purposes only and do not constitute an offer or a recommendation to buy or sell securities or other financial instruments. Readers should conduct their own review and exercise judgment prior to investing. Investments are not guaranteed, involve risk, and may result in a loss of principal. Past performance does not guarantee future results. Investments are not suitable for all types of investors.